Welcome back to Ausbiz. So this is the plot. Now, we know that there are a lot of new products out there, and we're going to talk about a new and innovative lending solution. It's launched its no monthly payments loan solution, and this is to help Australians unlock a portion of the equity in their home. To find out what exactly that means, joining me in the studio, Richard Young and Scott Collison, if I said that correctly, from Midkey. All right, let's start with you, Richard. I think we do want to know what the company is all about. Tell me about Midkey.
Well, Midkey, we sort of saw a significant problem in the market where we wanted to really help people solve their financial problems and realise their goals. And what we wanted to do is we identified that a lot of people had seen the value of their properties increase significantly, but their incomes hadn't, and therefore it was difficult for them to unlock the value in their homes through traditional bank sources.
So if someone said to you, what is Midkey, how would you define it as a company? You know, you could say you're a REIT, you're a real estate agent, you're this and that. What are you? What is Midkey?
Yeah, Midkey is an asset manager. We have a ACL, a credit license, and we've raised money that we are then on lending to consumers.
Okay, and I'm interested in this new product. I think, Scott, you're going to tell us about that. Is it the no monthly payment product? Now that sounds too good to be true, so you've got to explain the details here.
I will, Tessa, thank you so much. So the main thing is that when we make a loan, there's no principal or interest payments repaid during the life of the loan. Interest accumulates and is paid at the end of the loan. It accumulates at roughly 1% to 2% higher than a traditional home loan. It accumulates as simple interest, not compound interest. There are no repayments that are required until someone either sells their home or they make a voluntary repayment. The product can be lent as a first mortgage or a second mortgage. So a second mortgage is where we are lending in addition to a traditional home loan. It's available to all ages. And lastly, we have what we call a deferral fee. So the deferral fee allows us to charge a proportion of the increase in the property price over the life of the loan.
So you're trying to make the repayments easier by taking away interest payment to begin with?
We are still requiring interest to be paid, but the interest is only paid at the end of the loan, and then there's no fixed time frame for the repayment of the loan.
Okay, so that is, I can see why that's helpful to the consumer getting it, but as it is with these products, there's somebody taking on that risk. Is that you taking on the risk of changing the setup of this underlying risk there? It still exists. Are you taking that on? So if they don't pay,
the repayment risk. So yes. So as Richard said, we're established as an asset management business. So we're funded by primarily offshore institutional investors, and so those investors are happy to accept the non-payment of regular interest for the other benefits that they get from the loan. And they're typically quite long duration investors. So we have effectively matched the risk from our borrowers to our investors.
Okay, that sounds really interesting. And Scott mentioned that the age range, it covers a whole, large demographic. So tell me about who is the person that you're talking to, and perhaps you can give me a case study of how this actually works to get an idea.
Well, I suppose Midkey, key to unlock your midlife. So we've targeted 35 to 60-year-olds as our core group of borrowers, even though Scott said we can lend to anyone over the age of 18. Let me give you an example of the use cases. Is that what you'd like to? Well, some people use a Midkey. We've had some of our existing borrowers for cost of living issues, such as funding school fees. Other people have wanted their Midkeys for the purposes of finishing off a renovation or for starting a new business. So or for consolidating debts, and we've had some self-employed people owning businesses paying off their big GST claims. So there's an extraordinary diverse use cases for the Midkey, which is the wonderful, I suppose, unique feature in the way we've designed the product. Let me just give you a specific case. Say someone had $1 million house and we lent them $200,000, and that house went from 1 to 1.2 million in value over 5 years. then we would, because we've lent them 20% of the value of their property, we would share 20% of the upside in the value of that property. If the property didn't go up in value, we wouldn't share in the upside. There'd be no upside. So that we get, as Scott mentioned, simple interest through the course of the loan in addition to the deferral fee, which I just mentioned, only payable when there is an increase in the value of the property.
Okay, and so have you found your business increase in this cost of living, high interest rate environment? And how big is the sector? Because I'm just hearing of this now, but perhaps it's already a well-established sector. So tell me about the sector and if you've seen a rise in people going for your products.
Well, the sector, I think that's one of the things that attracted Scott and I to start the business. It is an enormous untapped opportunity or a very large problem that we're solving. In those use cases that I mentioned, some of those have been exacerbated in more recent times as a result of the increased cost of living and increased interest rates. So some people are having issues with repaying their first mortgages, so they're using a mid-key to reduce that. In terms of the size of the market, between it's in the tens of billions. It's a significant opportunity that we are tapping into.
Okay. What I'm interested in now from you, Scott, is, okay, this is a good product for, especially now with high interest rates, and people will be attracted to it. But what happens when we go back to a low interest rate environment? What is the draw of the vehicle that you're providing to people versus just going to a bank and doing it the traditional way?
So the product certainly has use cases in all different interest rate environments. As Richard said, it's particularly interesting as interest rates are increasing because it can be used to replace some of a traditional mortgage and therefore improve the cash flow of the home loan. But even when interest rates are low or decreasing, there are still homeowners that have seen the values of their properties increase more than their incomes. And so they are typically, in those scenarios, not able to access traditional debt funding. And so they still will want to release some equity in their homes. They're not able to do that with traditional funding. So we have relevance in all interest rate cycles.